Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by senior technical strategist and managing director Todd Sohn. Todd, how are you doing today?
Hey, Ross, I'm great, and it's always a pleasure to speak with you.
Good to talk to you as well. Obviously, been a pretty active week here in markets. So, I want to get your sense just up top of the sell off, and particularly, we kind of hit that down 9-10% level. Things started to feel pretty flushed this week, but I know you all look at a package of indicators, sentiment, and so on that gives you a good sense of where we're at in things. How do you take stock of the sell off so far?
Yeah, and it's as you mentioned, the first correction here since October of 2023. We flashed some modest oversold conditions from our technical work, and in terms of sentiment, we follow a bunch of various different measurements. The survey data, which we look at three different surveys ranging from institutional investors to retail investors, has gotten bearish. That's helpful. We've seen a spike in inverse ETF volume. That's ETFs that are betting that the market will decline, and usually that starts to cluster during declines as pessimism gets a little bit off sides. But the one missing component is a spike from the put volume, put call ratio. That's been very restrained for whatever reason. We don't know if this is partially because of the prominence of 0 days to expiration options, or perhaps everyone's moving over to those inverse ETF volume products. So that's kind of curious. But also adding to that is the VIX curve is inverted. So there's more negativity out there, which is helpful. We would actually love to see perhaps one more deeper flush, which is when you start to get a lot of technical divergences that help set up a more bullish stance into the second quarter. So I think you stay patient here. Perhaps there's a few more points to the downside, but at least sentiment is shifting in the right direction.
Yeah, and sentiment, a very helpful contrarian indicator, particularly at those big jumps or big drops. So we'll keep an eye on it. Speaking of the sell off, it has been led to the downside on a lot of these days by the Magnificent Seven, the big tech complex. You all have pointed out, over and over that tech has not really been relative leadership for quite some time now. But because of the prominence of the names, because it's such a big weight of the index, it is a question we get a lot, which is big tech viable here? Is technology something that you all like? I know you've done some work on technology, so what are your thoughts there?
Yeah, so in our technical sector rankings, tech is mid-tier, seventh as of middle of March here. So it's not exactly the same tech sector as it was earlier in the cycle, and so I want to be careful with it. I think you're seeing other sectors pick up that leadership, like financials, industrials to some extent, even utilities. And while you have flashed oversold conditions, keep in mind that only about half the tech sector is in an uptrend and going through this corrective process. And you think about it, if it wasn't large cap growth, it likely peaked late last year. And I think that's finally caught up to tech. So I'm being a bit patient here. On the positive side, the silver lining is that you are finally starting to see outflows from tech sector ETFs really start to accelerate. So flows had been all in on tech. That's finally ebbing. I think it's a necessary part of any course correction that's going on. So it's a bit more selective. I think you stay patient here and revisit those names once we get through this process. But for now, I'd rather sit on the sidelines and wait till a deeper flush happens for it all clear.
Right. And as you mentioned, there are other corners of the equity market, even within the US, that have been working. Financials is one that we've identified a lot since the election. So plenty to look at. And then I would say, outside of the US, one of the big stories this year has been the relative performance of international versus domestic stocks. I wonder just, do you think this has legs? Is this durable? We've seen a lot of head fakes from international over the last 15 years, ultimately amidst just broad US dominance. So is there a sea change here? Are you seeing anything that looks more durable, or is it another flash in the pan?
That's the question I think we'd all like to know. I like international diversification at this point because the Mag 7 is still 30% of the S&P 500. That's been a great benefit to most investors out there. But now's the time to at least look at those diversification. Look at what you're concentrating in your portfolio and consider international. So for example, Europe has had a great momentum, has a great participation. It's perhaps caught up tactically in a corrective environment right now. That's okay. And from our sentiment work, European ETF flows really had been restrained. Some of that's popped recently. That's a little bit performance chasing to us. And ETF issuers have kind of thrown in the towel on Europe too. So we like to believe that this has some room to run. Do we think it's the next decade story? That's too hard to answer, but we do like it for the next 6 to 12 months. And I would also point out that Europe, the way we invest in Europe is changing. European indices were always very heavy financials and staples and energy. Financials are still the dominant weight there, and they do act very well. The credit spreads on financial names are still very firm, so that's helpful. Meanwhile, staples have given up a lot of strength and energy as well. So you're seeing industrials step up and even some tech there too from a name like SAP. So the way we invest in Europe is still financials heavy, but also more cyclical is involved in there. I think that's an important change to the durable strength of international. Emerging markets still very much, I'd say, selective there. China has worked, but that's not for everybody. While India and LATAM are still in bear markets. And then we're waiting to see the next move from Japan. I don't think we have very high conviction on either side for Japan stocks right now, especially given the way the yen trades. It's created a little bit more volatility there. So I think I have the most conviction personally towards Europe and using any sort of deeper pullbacks here to continue to add exposure to that region.
All right, well, we won't hold it against you that you won't make a decade-long call. But Todd, thank you so much for the time today. Appreciate it as always. This has been great. And we'll look forward to talking to you again soon.
Thanks, Ross.